Hello and welcome to the Tax Roundup and Happy New Financial Year. Before we get underway, Mike Carruthers is going to take us quickly through those tax changes that have been announced but not enacted as yet and how we need to treat them.
Well, most of the media attention will be around where the carbon tax repeal bills are heading to with Parliament. From our point of view, it's important to not lose sight of where the mining tax repeal bills are as well, because it's the mining tax repeal bills that contain the amendments that will remove the loss carryback rules and will also change the simplified depreciation rules for small business entities. As things stand right at the moment, those bills are back before Parliament, and hopefully over the next 2, 3, 4 weeks, there will be some progress through the Senate as well. Now, if those bills do pass through the Senate and the carbon tax and the mining tax are removed, then we will have that reduction of the instant asset write-off threshold for small business entities from $6,500 back to $1,000, like it used to be a couple of years ago. The immediate deduction of $5,000 for motor vehicles will also be scrapped as well, and the loss carryback rules will disappear too. Now, from an administrative point of view, it's just worth bearing in mind what should you be doing if the bills don't pass through, or if there is another delay in those bills passing through. Now, if you come to preparing your client's 2014 tax returns and the bills haven't passed, then technically you apply the law as it stands at that time. So if the loss carryback rules are still there, then you're still allowed to apply the loss carryback rules for another year. Same with the simplified depreciation rules. Apply the rules as they stand at the time you're preparing and lodging the returns. Now, the important thing just to be aware of, and for clients especially, is that when and if the bills then do pass through, you'll need to go back and amend those returns. When it comes to the loss carryback rules, the ATO will probably do that automatically for you because you would have disclosed on the tax returns that had been claimed. The ATO will just go through and wipe off those, issue assessments for the extra tax that will need to be paid. When it comes to the simplified depreciation rules, the ATO won't necessarily know whether those additional deductions have been claimed. So you as tax agent, you'll need to assist your clients in going through that amendment process. So just as things stand right at the moment, the loss carryback rules are there right now. The increased depreciation write-off rate for small business entities and the motor vehicle rate is still there right now. But keep an eye out. We'll keep you updated over the next month or so, just where things are at, because it will be important just from an admin point of view. How do you actually prepare client tax returns for the 2014 year, which is ending at the moment?
And a big welcome to Ray this month, who's going to take us through the temporary budget repair levy.
The temporary budget repair levy received royal assent on the 25th of June and is now law. So as everybody with a higher income tax bracket would know, from the 1st of July 2014, there will be an extra 2% of tax to pay. There is a limited opportunity to do some effective salary packaging and maybe get a little bit more use out of your tax dollar, but that's only going to be until the new FBT rate kicks in on the 1st of April 2015. So now is the time to talk to your clients who haven't already got effective salary packaging in place to see if there's some way we can get a little bit of benefit for them until the new rates kick in on the 1st of April.
In cases this month, Mike Carruthers looks at what it actually takes to have tax debt released on hardship grounds.
Now, when it comes to cases this month, we thought we'd touch on something a little bit different. The case that we're going to be looking at is Power and the Commissioner of Taxation, an AAT decision that has gone through recently. Now, this case deals with a situation where the taxpayer owed a sum of money to the ATO and had applied to the Commissioner to release them from that tax debt on the basis of serious hardship. The Commissioner refused. Objection that was lodged was also knocked back, so the taxpayer decided to take the matter to the AAT. Now, the AAT firstly said that these tax debts, they were income tax debts primarily, they were of the sort of tax debt that could potentially be released, but there's a couple of other things you need to look at. The first thing is you need to prove that if you were forced to pay that tax debt, then you would suffer severe hardship. You also are then subject to Commissioner's discretion on top of that. Now, the AAT looked at the question of whether this taxpayer would suffer severe hardship were they forced, or if they were forced to pay the tax debts. Now, in this case, what the AAT did was they went through the taxpayer's income, so it was the income from their employment, a little bit of business income that they were deriving, plus also the family tax benefit payments that the taxpayer's wife was receiving. The AAT also looked at the teenage daughter's part-time income and decided that that would be excluded, that they wouldn't take that into account. So the AAT looked at, well, how much income was the family unit deriving on a fortnightly basis, and then compared that to the expenses that the taxpayer had provided. So typical weekly, fortnightly expenses that would arise. The AAT firstly cast a bit of doubt over some of those expenses and those estimates. They felt there was actually a bit of a gap there. They thought that some of the numbers that the taxpayer had provided were actually overstated. So already there was a bit of doubt as to were those expenses actual expenses that would have to be incurred. The other thing that the AAT took into account was the taxpayer's history. Now, these tax debts had accumulated over quite a period of time. They had slowly built up year after year. Interest had been accruing on those debts as well. For example, the taxpayer of 22 PAYG instalment periods had only ever paid 4 of those instalments. The taxpayer had entered into 3 separate payment arrangements with the ATO. 2 of them they had missed paying, and the 3rd one they had cancelled. So the AAT said, firstly, we don't think that this is a case of serious hardship. We think that if you put your mind to it, you could actually pay back those debts over a period of time. It might take 3, 4, 5 years, but you could slowly pay these over time if you managed your affairs in a better way. But aside from that, the ATO certainly took a very dim view of the taxpayer's history, the fact that they really didn't seem to be taking their tax obligations seriously. So if you ever do have clients who feel that having to pay a tax debt would suffer severe hardship, very important to go through that exercise of income versus expense, and also looking at, is there some factor that's been outside their control that has forced this situation upon them? In the power case, the AAT said no, it was the taxpayer's own fault. They just didn't manage their affairs. They didn't really pay attention to their tax obligations. It could be quite different if there was a sudden illness in the family, a death, something that was forced upon the taxpayer that meant that their circumstances were significantly different to what they had expected or anticipated. So in this case, the AAT refused the taxpayer's request to have those tax debts wiped, and they are left with having to pay those debts over a period of time, including all the interest that had been accruing over the years as well.
And that's the tax roundup for this month. Don't forget that if you're a member of Knowledge Shop, all the New Year standards are available for you on the Knowledge Bank. But if you're not a member of Knowledge Shop and you want to access work papers, checklists, new financial year standards for all the changes that we've got going through, then give Ray a call on 1800 800 232 and have a look at what we have on offer. Speak to you soon.